morning, traders. This is your Forex market commentary brought to you by Real ECN. Wrapping up this week's trading session, we will touch base on the euro-dollar market. Bearish bias continue to hold strong ahead of next week's ECB interest rate decision. Aggressive ECB easing policy was the underlying catalyst to this downturn in the single currency. However, in a market environment where risk appetite continues to be the prevailing theme and capital inflow into the eurozone is robust, the extent to this downward correction remain in question. I hope that this commentary will prove to be insightful for all our traders in formulating a successful trading strategy. So first, in line with this discussion, we will touch base on the euro-dollar market on a technical front. Here we have the euro-dollar market on an hourly chart time interval. The bear has definitely overpowered the bull over this week's trading session. The euro-dollar pair broke below the 1.3600 level on a weaker than expected German unemployment print. However, yesterday's disappointing US GDP report has given the pair the necessary momentum for a brief bounce to the upside, which was short-lived, as this GDP report did very little to shift the market's expectation on the Fed's monetary policy. On the multi-month time interval, the euro-dollar recent price action has broken below the wedge formation. Now, this descending channel is targeted at the 1.3294 zone. So in accordance to the SSI, which is commonly known as the Speculative Sentiment Index, there has been a major shift in retail trader sentiment on the single currency for the first time since the pair bottomed out at the 1.28 zone. The shift in sentiment translates to a net increase in long interest in the euro-dollar pair. Analysts are suggesting taking the contrarian standpoint to this crowd sentiment, and this shift in sentiment into long net interest leaves analysts in favor of further weakness, where the bear work forced the euro-dollar pair to break further support tier. After peaking out at the 1.400 zone, the euro-dollar pair has undergone significant correction to the downside. With respect to retail trader sentiment towards this correction, net long interest has grown by 200%. This can potentially give rise to a near-term euro-dollar bounce. Thus, entering into short position at this point does not justify its risk and reward profile. However, it is also important to note that any near-term bounce will likely be tested by the resistance point at the 1.3710 level. Analysis of a collection of technical indicators on the hourly interval on the euro-dollar cross is suggestive of a temporary bearish market sentiment and recommends short positions on the euro. The euro-dollar cross opens today's Sydney trading session 1 pip below the established Fibonacci support at 1.3599, while the Fibonacci resistance is set at 1.3603. Heading into this week's trading session, the euro-dollar market continued to maintain its bearish momentum as the pair continued to trade below the 200-day simple moving average. The significance of 200-day simple moving average cannot be understated, as 200 days SMA contain more or less a 1 year's worth of trading data. Since the euro-dollar cross opens today's trading session below the 200 days, this is very indicative of a long-term bearish outlook on the cross moving forward. This bearish standpoint is also validated on the short-term moving average front, as the pair opened today's Sydney trading session below the 5, 10, 20, and 30 days SMA, which is indicative of a sell recommendation on the moving average front. Also, supporting this viewpoint is the CCI, which is flashing sell recommendation as the price action is breaking down into bearish territory. Even the RSI has failed to maintain the bullish momentum and is showing signs of breaking down into bearish territory as well. Now, moving along to the fundamental aspect of the euro-dollar market. During Wednesday's trading session, the market observed the euro-dollar pair breaking below the 1.3600 for the first time this week. This was largely due to two major risk events. The first one being that the Eurozone M3 money supply year-on-year coming in lower than expectation at 0.8% when forecast expects a 1.1% reading. The slowing in the pace of growth in the Eurozone money supply can hinder the expectation that inflation will likely continue to remain sluggish. And since CPI growth is one of the critical component in the ECB's forward guidance mandate, this would only lower the market expectation that the ECB will move away from its dovish rhetorical. The second major risk event that triggered Wednesday euro-dollar decline could be attributed to the German unemployment change number. Market consensus expect a 15K contraction in unemployment print. However, unemployment claim grew by 24K. Despite the German unemployment rate remained unchanged at 6.7%, a 25K unemployment claim is the highest jobless claim since 2009. A weak labor market outlook on Europe's biggest growth engine also worked to reinforce the ECB argument for further easing. The market is usually very forward-looking in terms of quick to price in the expectation of a shift in monetary policy. The prevailing expectation is that Draghi will implement further easing policy through cutting benchmark rate, introduce negative deposit rate to encourage money velocity into risky asset, chasing yield, or even terminate the sterilization of its bond purchasing program. Once the market fully priced in all these easing options, the single currency won't be able to sustain this elevated level against the greenback. Therefore, next Thursday, ECB interest rate decision and minutes release will hold precedent on next week's calendar. However, it is also important to consider another fundamental component that holds influence over the euro-dollar cross. Without a doubt, the market pricing in ECB aggressive easing policy was the trigger for the euro-dollar to break the support floor of its rising wedge formation. However, the market continued to favor risk appetite and capital investment into Eurozone also remain robust. These fundamental factors have the potential to hinder this long-term bearish bias. I hope that everybody will have a successful trading session, and good luck everybody. Thank you for your time and thank you for listening.